Hey, what's going on, everybody? Welcome back to Bonafide Investing, where we talk all things high yield investing, futures, options, and investment goals in general. If you're new to the channel, welcome. A little bit of background about what we're doing here. I've been experimenting with high yield strategies for about the past year and a half, and I have built what I call an all-weather high yield portfolio, taking about 20 to 25% of my net worth that seeks to, number one, pay my bills, and number two, maintain and pay down my margin over time. Please hit like and subscribe. If you like what we're doing here, help support the channel. Please know that everything we discuss here is not investment advice, not now, not ever. So what I want to do today is talk about just some changes to the portfolio overall, some of my thoughts about a couple ETFs and what I'm doing here. And what we'll start off with is I bought a Boyle $15 call yesterday. I bought a VXX $25 call, both expiring March 20th. This is a play on, again, more energy exposure, as I think natural gas sometimes lags oil, but I am very bullish on oil. That is my speculation play for 2026. And we saw natural gas get absolutely hammered over the past month. So I also think volatility is going to pick up throughout 2026. So I just did a 2-month call on both just to see if I need to roll them, right? The closer we get, if they haven't done what I'm seeking or hoping they'll do, or I'll exercise them if we get a nice bump here. So a couple things I did. I added another 500 shares of KYLD today, bringing my share total to 1,000 shares. I've really liked what it's been doing. I like that it's got high exposure to gold and silver miners right now, as I think as crazy high as these precious metals have gotten. I think the miners still have a little bit of catch up to play. So I like KYLD's exposure there. I like the 38% yield that's been consistent each and every week. I also added another 1,000 shares of YQQQ. Again, I've said before in past videos, I am no fan of where these markets currently sit. And I want to have a little bit more downside hedge for the indices. And like I've said, the NASDAQ 100, the S&P 500 have sort of become the S&P 100. Very blended, a lot of overlap. So I think YQQQ will also help protect against any correction, I think, across the S&P 500 as well as the NASDAQ. Another thing I did, so I built my own long-short fund. Now, I bought $10,000 of ULTY, $10,000 of SLTY. The old adage, fool me once, shame on you. Fool me twice, shame on me. I've owned ULT a couple different times. Never really disappointed in it, but also wasn't a big fan of it. Now, YieldMax has made a lot of changes to ULT, to their strategy. It's become more conservative. And what I did, I was really kind of wanting to buy NLSI. Let's look at this real quick. This is Neos's long short equity income. Now, it did come out, let's see, it listed on December 10th. And what happened was there was a lot of speculation around what that first distribution might look like. Was it going to be 20%, 30%, 40%? I like Neos. I like the managers. I like what they're doing. You guys know that I'm dollar cost averaging back into QQQI and SPYI each and every market day. It's a large chunk of my overall strategy across cash flow life. But it was interesting that the distribution was only about a 5 to 6% annualized distribution. Now, keep in mind the fund had only been listed a couple weeks, right? That might have had something to do with it. But we'll find out next week if this distribution will go up. But around 5 to 6%, yeah, you're probably not going to get a lot of NAV erosion and a lot more stability across this long-short strategy. But not really, I don't think, a fit right now for what I'm trying to accomplish in cash flow life. Next week, if it is into that maybe 30, 40% range or higher, annualized distribution, what I might do is buy a little bit of NLSI, get a little exposure there, just to kind of see how it does against ULT and Salty. Another nice thing, maintenance ratio did drop down to 25% on NLSI. I know it was at 100%. Robinhood likes to have a lot of their funds when they're first listed come out around 100%, I think, till they pay 1 or 2 distributions, and then they'll usually drop that. But again, I guess I was a little disappointed with the distribution on NLSI, but we'll see how that looks next week, as I do have to kind of take it with a grain of salt for the fact that it only had a couple weeks after it was listed. So getting back to where we sit with everything, my game plan with Ulti and Salty for 2026, what I think I'll do, I was going to, if one of them, went down 20% more than the other, I was going to rebalance, maybe add a little bit to that one. What I think I'll do instead, since it's only $10,000 across each, $20,000 total, I think I will use those distributions throughout 26 to pay down and maintain the margin better. This week's distribution that was declared today, they'll go ex-div, they'll both go ex-dividend tomorrow, was about 70% annualized for Ulti and about 60% annualized for Salty. So that's about a 65% annualized yield there. Again, I know that they will succumb to NAV erosion, very aware of that. But I want to see, again, how the extra distributions at about $1,000 a month, maybe a little more, will help, pay down that margin, maintain that margin. Since I am, again, dollar cost averaging $200 per market day back into these that you see the plus signs by, right? WPay, I have to manually add $30 every day. I already did that. So I am not dollar cost averaging back into KYLD. I'm not dollar cost averaging into Ulti, Salty, or YQQQ either. Okay. So again, these are strictly a hedge via YQQQ and Salty, and high income plays across KYLD, Ulti, and Salty. Now, YQQQ does pay about a 20% annualized distribution, which is nice. So like I said before, this is just a correction hedge. I'm getting paid. If the markets do keep going up, great. I'll get paid to wait. But again, I do think a significant correction, if not a crash, is on the horizon here. When? Nobody knows. But should a crash come, I've got my QQQ puts, my SPY puts, and just to kind of show what that might look like, if we did have a big crash, because we can actually look at, under simulate my returns, what that might look like. Let's say we did get a big crash here should probably go a little slower. Looks like I'm overwhelming it here. Let's say the S&P 500 crashes 50%. Okay, let's say we get a 50% crash from here. What's nice is you can see I'm going to get roughly $90,000, right, just from these SPY puts if I were to exercise them there, which is going to help buffer a lot of that downside. Okay, if we go into some more severe, let's say we go into some severe crash. Again, I'm not the biggest fan of Robinhood's tools. This is another good example of that. So I got to go a little slower than I like. But let's say we got an 80% market crash, right? Let's say we got something that we go back and test the 2008, 2009 lows. Okay. We're looking at what? About $193,000, $194,000, right? To the downside that these puts will kick in. So again, they can go up hundreds, sometimes thousands of percents, right? In a market crash. That's why I keep them on the portfolio. I don't want to get wiped out. Okay. VXX acts as another one, right? If you buy a long call on VXX, you are typically betting that the markets will go down as volatility rises, right? We have been seeing some volatility, the VIX go up a little bit, even on up days. So again, the VIX is super low right now. I think that we are due for a correction, if not more volatility across the markets. So that's the play there. And then again, oil, just more speculation here. Again, targeting putting back in 10% to SGov, 10% to TLTW each and every market day, putting back in 5% into CRF, 15% into WPay, 5% into YMAX, 5% into QDTE, 5% QLDY, 5% QQQI, 5% XDTE, 5% into SPY-I, 5% into RDTE, looking to put back in about 2% into GDXY every day, 20% into GLDY, 5% into IAU, 5% into IGLD, 3% into IYRI. So sorry for that long, boring list, but just want to show you what I'm dollar cost averaging it back into, as those are my target allocations. Now, when I rebalance in March, these numbers are not going to look, as close as they did before I added some of these other holdings, KYLD, ULTY, SLTY, and YQQQ. Since I put those, I'm going to have to rebalance around, taking those out. Okay. So looking at the numbers, here's what's really cool. I invested about $45,000 using margin back into this strategy. I'm now using about 25% margin and about 75% of my own equity. So we have about $625,000 invested, just to do some back of the envelope math, between the $465,000 roughly of my capital and about $160,000 of margin used. What's really great is after making those changes, my margin buffer fell from 63.5% down to roughly 61%. So I'll take that all day long, right? To use $45,000 of margin at 4.5% interest to buy some high yielders and some hedging along the way. So again, happy with the allocation, happy with where we sit. I think that bumped up as of this week, and I'll update it over the weekend. That bumped up my annualized income to about 160,000 annualized. Okay. But again, I'll update that at the end of the week after all distributions have been declared. All the shares have been updated as well. So that 160,000, considering my bills annually are about 116,000 to 117,000, right in there. That's going to be a nice, I guess, margin pay down, or at least keeping my margin steady, right? So I really like that. But again, wanted to give some portfolio updates. So far, so good. Love to hear your thoughts and comments. Maybe what you're doing, maybe some ideas here. But yeah, hope you got something from today's video, and have a great day.